Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host here for about the next 30 minutes or so. And this previous Friday, we did an options education course. We talked a lot about delta and gamma and how they are related. If you would like to learn more about those Greeks, please feel free to go back and look at the archives of the show. I did that because I was actually traveling to Chicago, to the Chicago Board Option Exchange on that day, to be more exact. And we took time out to try to learn a little bit about those Greeks. Now, with that said, there were a lot of trades that we put on previously. We are still at the tail end of earnings, so we looked at a couple of speculative trades. So far, our paper trades that we've looked at around earnings have been fairly strong. As a matter of fact, we looked at MRO, Marathon Oil, last week, and we ended up doing two different paper trades, to be blunt, because I did not have that date right on the earnings. I was looking at Marathon Petroleum, but both of the trades worked out. And so we're going to look at that trade this week in MRO, which was a long call spread, very speculative, very short term. And then we went out and based off of some of the comments that people were talking about on Apple, we took the time to look at a protective trade in Apple, how to buy protection on the stock going into earnings at a fairly low cost relative to buying the put outright. That was the trade that we looked at. But I think the trade that I was the most excited about was IWM. I don't have many opportunities where I like to talk about long straddles in the marketplace, where we're buying the at the money put and buying the at the money call. But the IWM chart was very interesting. And not to mention, we are coming out of October. So there were, when we put the trade on, there was still just a few days left in October. And by the way, congratulations on that. We made it through September and October, and they both proved to be very volatile months. Once again, September definitely underperformed the market so far this year, and October was a little bit mixed, but definitely gave us some scares. But now we're in November and we're seeing a few updates that have happened. We're getting through this earnings period. We still got a few companies that are going to be announcing this week. There's none that I'm going to really focus on as a paper trade this week, but I am going to add a stock to our fig leaf portfolio, which means we're buying deep in the money calls and selling out of the money calls against it. And the stock that we're going to focus on in our paper trading portfolio is going to be Caterpillar. So right now inside the TradeHawk software and the TradeHawk options grid, I actually have Caterpillar up and I'm showing that. I'm going to take a second. I'm going to jump over to the charts and we're going to look at what happened in MRO. So in MRO, this is the day that we're focusing on, and I zoomed in on this chart. It was a 365-day chart, but this is the day when all the volume happened. And the trade that we did kind of worked out, right? It didn't. It definitely was a winner on that trade, but we didn't blow it out of the water by any means. So we went in on MRO on Wednesday before their Thursday earnings announcement in the morning, and we did a long call spread and we straddled the market. Our goal there was to buy as much time premium as we were selling. The call that we sold that we really wanted the stock to get to was the 29 strike call. Now, remember, this is our second long call spread that we did in MRO. And the first one actually worked out. It actually made the maximum that it could on the trade, well, close to the maximum. And on this one, we ended up selling the 29. So I'm just going to highlight this right here and let you know this was the day. Look at the bottom of the screen. You'll see that that's the 2nd of November, which was that Thursday. And the high on the day, as far as that position was, it was fairly close to the close. So the stock got up to 28, which wasn't quite where we wanted it. It was at 27.43. So we did get a 50-cent move on a $27 stock. That's not horrible, right? And it closed at 28. So here's the way that I would have approached it. If you're doing a speculative trade like that, we had a very, very short expiration. Our expiration date was that Friday, which would have been the very next day. Going into the close, definitely would have closed it out, and it would have made. We put the whole trade on for 148. I would assume that we could have sold it for close to $2. Mainly because all the time premium came out of it. The maximum that it would have traded for would be $3, and I would have closed it out. If you're doing a speculative trade, they announce the earnings, you have that event. A lot of times I'm going to close out the trade before noon, which you did have opportunities. But if you did ride it all day long, it did end up closing. It ran up to 28, came back down, and then finished right around 28. So at that point in time, you should definitely just get out of the trade. And if you didn't and you waited around till Friday, you see that we have a red candle here, which means we closed on the lower end of the marketplace as on the red candle as opposed to the top. And so you wouldn't have done as well on the trade. On that day, it looks like we had the 200. We came all the way down to about 27.20. So we would have finished below where the underlying was at when we started, which was 27.43. So it wouldn't have been good if we would have gone and did that trade. Just in general, if you would have stuck around one extra day, but you should have been out for sure on Thursday. And I think that's what we usually talk about on our speculative paper trades that we look at. So now I'm going to go back to the trading tab and look at the options grid here. And inside this options grid, we went and looked at Apple. So Apple is now up today, and it's trading at 178. When we did the Apple trade, we saw the underlying market was at 171.42. And Apple, we did this on a Wednesday, and it was more so that a lot of people were just nervous about Apple and everything that's going on with China, where they're going to have a strong quarter. And their earnings were fairly decent, but I'd give it a mixed grade, I guess. And our insurance that we bought, the long put spread, allowed us to stay in the marketplace. And Apple, in hindsight now, has been fairly strong. Once again, we're getting into November and December. Hopefully, we can get some of that Santa Claus rally going into the new year. This is when I wanted to get long the market. I want to start allocating some capital into the marketplace. We saw a couple of decent things that happened. We saw the 10 years came off a little bit, but more importantly, with this concept of maybe feeling good about what's going on into the new year, that's still obviously there's a lot of landmines that are out there, not to mention geopolitical landmines, but just in general with what the Fed is doing. The Fed keeps saying they want to be hawkish, but the futures contracts, the CME Fed Watch, is disagreeing with what the Fed speak is. And what is interesting to me, if we look at the December 13th meeting for the Fed, they're now saying there's only about a 10% chance of the Fed increasing rates by 0.25%. And the 10 years kind of reflected that. I think that's really what sparked the rally, is that we've seen interest rates on the 10 year come down from the 5 to now about 4.6%. And I can try putting the 10 year in T and X. Not sure on the paper trading platform if it will give me a quote. No, it's not going to give me a quote. And on the paper trading platform, a lot of these major indexes, we don't get quotes on the paper trading. If you're in the real account, you can see that. But so I went out and I looked at March, because I was fishing for a rate cut, right? When are they considering maybe reducing the Fed funds rate as opposed to increasing it? And if you look at the March 20th meeting, I was surprised to see that the Fed futures are showing a 23% chance of a cut. They'd also have a 10% chance of a raise, so much the same as the December 13th meeting. More than likely, obviously, the highest probability is that they're going to stay the course and keep the Fed funds right where it's at. But I was surprised to see that there's now a 23% chance of a cut by that March 20th meeting. Okay. So if we did get a cut, I think that would probably be the biggest driver of the marketplace to push things higher. So let's look at what happened in Apple. So we see Apple is up today, $2.09. It was kind of mixed on the day that they announced earnings. Like I said, it was that Thursday after the close. So I'm going to go in and let's pull up Apple and we'll zoom in on it. And we'll just kind of look and show you what happened. Now, when you're buying protection on a stock like Apple or any underlying stock, you're looking, you got to remember that you're bullish but nervous. And the best case scenario is that the stock goes up. We were able to reduce our cost of our protection to $1.28, and Apple's up more than that right now. So it's paid for our deductible. So if we had 100, well, it would be the deductible plus the premium. That would have been the premium paid would be a better word to use. But if the underlying stock now has gone up 2 points, we paid $1.28. That 100 shares that we were protecting basically paid for our position and allowed us to ride that earnings report without panicking and selling the stock. So here's where it happened. So let me zoom in this area here on Apple. We've had some tough times, a little bit of chop. Market still for the year is up pretty good at Apple. And then this was the second. Okay, so this is when they announced earnings. That was on the close. Had a volatile day the next day. This would have been that Friday. And on that Friday, we did close near the high because we got the white candle, but we got all the way down to 173. Our protective put wasn't even really in the realm. It was 167.50. There might have been something to sell, but we bought the 167.50 put and sold the 162.50 put and paid $1.28 for it. But then this morning, obviously, if we come back and look at this most recent date and today and what's going on in the marketplace, we see that it's back. It's strong. It's doing fairly well. So they digested the news and any forecasts that Apple made, which Apple's pretty good at making forecasts and giving you a general heads up of what's going on with the company. And now we're back again. So you can say, well, did we lose money trading options or did we make money? And this is where it's always so the minutia of the option trading world. The trade did what we wanted it to do. We wanted the stock to go up at least enough to pay for our protection on the downside. And I'll go back in. Let's run back to the trading software and the expiration date that we use. So it's still alive, actually. I'm kind of acting like it expired, and it didn't. I got the Caterpillar trade all up and running. But let's go back and look at the date that we chose was the November 10th expiration. And it's trading for next to nothing. And that's what I kind of figured. But you might have had an opportunity if you decided when it was down a little bit to sell out to actually salvage some of the $1.28 or $128 that you put in to protect your 100 shares of stock. But I'm going to click on, this is the trade that we did. We bought the 167. We sold the 162.50, gave us 5 points of protection. The stock was at 171, so it was trading somewhere between these two strikes, 171.42. So we had a $2.50 deductible, and then we had a $5 of protection down to 162.50. That would have helped us out, but we still got a few days left, and I would just stay the course on it. If I had this on, we got through the big news event. If I saw this, I actually might even put a limit order in on this trade and go on in and say, well, if I can sell this for 50 cents, I'm going to get out, something like that. So you just put a limit order, good till canceled. If it doesn't happen by November 10th, well, then it just expires worthless. But that's the way that I would trade it. We bought this for that specific news event. It's done its job. It let us stay in the stock. Now, if you can salvage something from it, go ahead and do that. But hopefully Apple just continues on up, and the 100 shares that this long put spread protected goes in and actually helps you out then on that trade. All right. So let's get on. If you have any questions, this is probably a good time to say that. Why don't you toss them in the chat box, and I'll see if I can answer them anytime during the show. We'd like to make Options Guy TV as active as possible if we can. And so feel free to put them in the chat box. That's simple. That's simple. Now, let's run out and look at our trade. Well, let's look at the IWM trade. I guess we getting a little long on the tooth, but the IWM trade was really fun. I don't get to talk about a lot of long straddles just because buying premium is really tough to do. If you look at the math of the marketplace, it says if you buy a put and you buy a call at the same strike, usually I never want to do it around an earnings event because there's just too much premium, too much juice in the options contracts. But I will do it if we see a chart that's really interesting. And so I'm gonna. Here's where IWM is at right now. It's down a couple of points, but it really made a strong run last week, almost right after we did our trade. So let's pull up IWM, which is the Russell 2000 ETF that tracks the Russell 2000 index, and close that. And let's go out. Let's go out about 800 days, a couple of years here, and you'll see that there's definitely this area right here on the chart. There's a lot of activity and there's a lot of noise. We came down, we almost touched it. We didn't quite, but we bounced off it here, and we came back. And this would have been the third time that we would have hit this area and had, just nervousness and what's going on with the small caps and what they're doing in the marketplace. But you also see the wide range. When it came down to that area, moved up strongly, even stronger after that. So this was a positive sign because you came up, made a new high relative in that short time period, came down and made a low. It wasn't quite as low of a low, and then had a strong move to the upside. So right here, you still got the same, almost the exact same situation that we were targeting on the downside, right around that 200 level. That would be a very interesting place to once again maybe do a long straddle, or if you can break out of that, just go ahead and the next stopping point looks like somewhere around 210. It's where we had this gap down, and this was where that high was before it started dropping off precipitously. Okay, well, we were right there. We hung there, and guess what it did? It supported us. Had a real strong up day then. So we're still in a daily. Let me zoom in. Let me grab this area right here. And right around one. So when we did the IWM trade, let me look at my notes here. IWM was at 163, right about where my cursor is. And you see the strong up days, real strong white candles all the way up to 174, almost hit the, what is this, the 50-day moving average? That's the 200. This is the 20. Yeah, that would be the 50. Yep, the blue. There it is right there. And we almost hit the 50 and then bounced back a little bit here. So, yeah, that trade, we were looking for about a 5% move is what we needed. We paid flat out, the fact that it happened fast sooner than later. We paid $735 for the call and the put, and we got almost that much of a move to the upside from, well, more than that, right? 163 down here all the way up to 174. So here's the question now, and this is the hardest question about long straddles. When do you get out, right? And with this long straddle, we were going out to November 17th. We got more than what we paid for it just from the call side of things. So that call should have been trading for 10, 11 bucks. And I would have probably got out on the close on this day. I wouldn't have wanted to take that market risk over the weekend. And I would have sold the call and remained long the put. That simple. Very rarely do I close everything when I'm looking at a long straddle. You looked at the chart of IWM, there's definitely potential for this thing to come all the way back down and break down to the downside by the 17th. It has moved that much. This is 1, 2, 3, 4 sessions, and it was all the way back down there. So we got to the 17th. We got a little bit of a down day. There's still a chance that could happen. I would think that the market, right now, the market sentiment is a little bit bullish. Like I said, we got through October, and that is a big deal. And on top of it, we now are seeing the interest rates come in a little bit. And the Fed, even though the Fed is still trying to be hawkish, the marketplace is saying that they are lying to us a little bit, at least. They want to keep that hawkish stance in, but I was really surprised to see that March 20th potential rate cut. 23% is a feasible number. I mean, that could happen. Do a lot of option trades where there's a 25% chance of that thing hitting the maximum, right? That's a normal trade that I've done many times on Options Guy TV. All right, so if you have any questions, put them in that chat box. And if not, then we talked all three of the trades. We're going to come back and look at, and if there are any questions, just toss them in there, Reuven. I can't really see it over there. So go ahead and just put them up and we'll address them as they go. Okay. And now let's go back to trading. Okay. So let's add a fig leaf to our portfolio today. I got a few minutes left here. So we're going to add one. I think it's time. Oh, here's the IWM long straddle. I forgot that I threw that in there. Interesting. Okay. So that is the actual straddle showing up 148% on that call, down 89%. We got Google, we got NVIDIA, Caterpillar, good solid company. And I've done a fig leaf in Caterpillar before. But, strong demand, good industrial company. If we do start fixing some of the infrastructure, I mean, that would be the go-to stock. So we've added an AI. Well, you could say Google is AI too, but we did NVIDIA. NVIDIA had earnings and came off those earnings and has really struggled. So in NVIDIA, we'll probably do this on Wednesday. We'll probably sell a call in NVIDIA because we need to add a call to that position. We'll go back on Google. Google has gotten beaten up a little bit since their earnings report. It's bouncing back, but it was kind of surprising to see how much they sold off after their earnings. We'll sell a call on that position, and that's what we'll do next week. And so here we're going to start by just buying. Here's what I'll do. We're going to buy the Caterpillar deep in the money call option like we have on NVIDIA and on Google. And then on Wednesday, we'll come back and sell calls on all of those positions. And this is, once again, our paper trading portfolio. I'm going to keep track of this portfolio throughout the year, and I'm going to add a couple more stocks. And I want to try to be diverse. And one of the things was I really kind of wanted to get long Google going into earnings. That one didn't turn out that well. Microsoft would have been the one. Microsoft actually did well going into earnings, but I think what happened with Alphabet / Google is that they the people didn't really like what they said about AI, even though they keep saying that something big is coming. I don't think that they convinced the marketplace that something big is coming in AI in their world. All right, here's the options grid. And Caterpillar. I like Caterpillar. Just a good company, pays a good dividend. We're going to go way out in time. So I only have one screen today because I'm traveling still, and I'll be traveling for the rest of this week. But Caterpillar right now, we're showing the November 11th expiration. I'm going to take the options grid. I'm going to go all the way across. We're going to go all the way out, just like the other positions that we have. We're going to go out to 2025, which is over 400 days away, January 17th. We're going to click on that. Now we have that grid. Quite simply, we're going to go down and look at Delta. Because if you look inside the options playbook, if you go to optionsplaybook.com and you look at the fig leaf option strategy, it says in there that you want to go longer term leap options and you want to buy an 80 delta or so. So in this instance, we're right in the middle, right? We could do the 200. We're going to be paying about $19 in extrinsic value and time value, or we could do the 210 and we're paying about $21.7. We'll call it $22 in extrinsic value. That is the big deal because that's what we're going to battle. That's why we're going to sell calls, is we want to whittle this down over the next, how many days we got? 438 days. So we'll be selling short-term premium against them. And we're going to put the position on today because it's down a little bit. They announced earnings too, like most of the companies. And it's just kind of been wavering, the underlying stock. Feel free to look at the chart. There's nothing too interesting in it on by my eye, at least there isn't. So we're going to go down to the 200 strike and we're going to be paying about $57. So if we bought this underlying stock, it would be, if we bought this stock, I just apologize for that, 237.92 is where it's at. We bought 100 shares of it. That would be $23,792. But instead of buying that, we're going to buy something that acts like that stock. It's got, well, let's jump up to this one. I like the $50 range because we could say it's $50. So that's simple. And we buy the 210, and we'll say that we did that for $50. Okay. So if you take 50 and you divide that by the price of the stock, 230, 237. 50 divided by 237. We're putting in about 20% of the stock price. So we're getting something that has 80 delta. Oh, it moved on me. Okay. That has 78 delta. That means if the underlying stock goes up 1, this option contract should go up by about 78 cents, or basically make you $78. So the stock, if it went up 1, would make you $100 on 100 shares. This option, in theory, should make you about $78 on one option contract. We only put up 20% of the underlying stock, but we were going way out in time, so we got a lot of time premium to try to wither away. So this is bullish but nervous strategy. Once again, that's what we're doing here when Caterpillar. And when we come back, I'm going to execute this trade today inside this paper trading platform. And when we come back on Wednesday, we'll just sell some call options. And that'll be the theme of the show on Wednesday. Since we've already got through most of our earnings, I'll look next week if there's a company that is interesting that we might want to do a speculative trade on for earnings, we'll do that. I should say if we come back on Wednesday and there is a speculative trade on earnings that we can consider, we'll look at that. But in general, this Wednesday, we'll look at just selling calls on our paper portfolio of deep in the money option contracts. All right, so let's click on this. That puts the trade right there. Buy to open, 148. We're in the paper trading platform, so unfortunately can't really work this order. And that's one of the biggest things about option trading with leaps is that you do have to pay wider bid-ask spreads the further you go out in time. It's a paper trade. I would try to work this in the real market, but it's really not going to work in general on the paper trading app. All right, and I'm on this one little screen, so I'm going to unlock this and move this. This one is what I got to move over, and then I'm going to hit send. And so here we go. We're buying to open the 210 call option at 50.75, which is the asking price in Caterpillar. Underlying expiration date 2025 1/17, January of 2025, and we hit send. And that should add that. There we go. That should add that to our portfolio. It should show up there fairly quick, I would assume. 775. Did it move on us? It did move, didn't it? All right. I'll make sure that that went in. And let's see where our note's at over here. I know my face is covering our little note over there, but there it is. Status is open. It's trading there. I might have to adjust it a little bit. But if you have any questions, if there's any questions out there, just toss them up. And if there isn't, well, thanks for coming, everyone. And we'll see you this Wednesday for the next edition of Options Guy TV. If you're in the YouTube platform, please click subscribe, ring the bell so you get all the alerts, and pound that thumbs up. It helps us here on Options Guy TV. And we'll see you this Wednesday at 11 a.m. Eastern time for the next edition of Options Guy TV. Thanks for coming, everyone.